When it comes to securing financing for your business, there are various options to consider, with business lines of credit and loans being two of the most common choices. But how do you decide which one is right for your specific needs? Let's explore the key differences between business lines of credit and loans to help you make an informed decision. Understanding business line of credit versus loan. Before we explore the pros and cons of each financing option, let's clarify the fundamental differences. Business loan. A lump sum of money borrowed for a specific purpose with set repayment terms and interest rates. Business loans are typically used for large, one-time expenses. Business line of credit. A revolving credit facility that provides access to a predetermined amount of money. You can draw from this line of credit as needed, pay interest only on the amount used, and reuse the credit as you repay it. Business lines of credit offer flexibility for ongoing or unexpected expenses. The flexibility factor. If flexibility is a top priority for your business, then a business line of credit may be the ideal choice. Unlike a traditional loan, which provides a one-time lump sum, a business line of credit gives you the freedom to access funds when you need them. This flexibility can be a lifesaver for businesses with varying cash flow needs, enabling you to cover unexpected expenses or take advantage of growth opportunities. Interest costs, business line of credit versus loan. The cost of borrowing is another critical aspect to consider. Business lines of credit typically come with variable interest rates, while loans offer fixed interest rates. If you're concerned about interest rate fluctuations affecting your costs, a business loan might be a safer bet. However, lines of credit can offer lower interest costs when managed wisely. Qualification and application process. When comparing business lines of credit versus loans, one key advantage is the ease of qualification and application. Traditional banks often have stringent requirements for loans, including high credit scores and extensive financial documentation. In contrast, obtaining a business line of credit is typically easier, making it a viable option for newer businesses or those with less than perfect credit. Collateral and security, a loan requirement. Most business loans require collateral, which is a valuable asset you pledge to secure the loan. Collateral provides security for the lender, but can be a risk for borrowers if they're unable to repay the loan. On the other hand, business lines of credit are often unsecured, meaning you don't need to put up collateral.
Have you been struggling to find business funding? What about an instantly approved $3,000 to $25,000? Would that help you? Well, let me tell you, I might have some solutions for you if possibly your credit is a little on the fair side and maybe you've just started your business. So let me ask you, have you been in business at least 6 months? Do you have at least a 600 credit score? Do you have your last 3 months of bank statements? If you have those things, I have a source for you that can help you. Instantly approvals mean the day that you put your documentation in and you get your approvals, if it's before 12 p.m., you get your money same day. If it's after 12 p.m., you get your money the next day. Listen, COVID has provided us some certain avenues to deal with challenges. This is one of those that I hope helps you. The link is below.
All right, in this training, we're going to talk about the 4 alternatives a business owner has for capital to grow their business or get through a tight pinch, and why DAC is the best source 80% of the time. So here's an example. You got a restaurant owner who wants to add a patio. They want to add more seats. You know, they say the average restaurant seat generates about $20,000 in revenue per year. So the more seats you have, the more revenue you're going to do. So this restaurant wants to add a patio. They're going to need $100,000. Well, maybe they are in a tight pinch and they need $100,000. Maybe they want to buy another location. Maybe they want to buy a new oven. Doesn't matter the use of funds. This is just an example. But let's say they need that $100,000. What are their 4 choices? Well, number 1, they've got their own savings, their own working capital. If they've got it, they use it, and we move on. We can't help them. Or maybe they have friends and family who are willing to give them the money, and the business owner is willing to deal with the pressure of owning a friend money and the guilt of taking a vacation while still owning that friend money. Or maybe they'll sell part of their company and bring on a partner through friends and family. But so those are 2 alternatives that business owner has, right? And then the third alternative is the big bank. Well, the big banks are great for some people. First of all, you have to have great credit. And if you have great credit and you want a big loan, they're really good. But here's your 4 ways a bank can help a business owner. Actually, there's 3 that they help a business owner. One is a credit card. Generally, as long as you have a good credit score of at least 670 or 700 above, you can get a credit card from the bank. But it's usually, $5,000, $10,000, $25,000. And if you're a business, you're not going to get a credit card unless you've been in business several years, right? The second way is what they call a revolving line of credit. It acts just like a credit card. It's just a higher balance or a higher approval amount. And that's approved by the bank themselves. Again, you generally have to have a 700 credit score or higher, which rules out over 80% of the business owners out there. And also you have to be in business for at least 1 or 2 years. And you have to be doing a lot of revenue. So that rules out, again, 80% of the businesses. The third way a bank could help is a bank loan. Now, there's 2 things about a big bank loan. Number one, they want it to be at least $500,000 or more before they want to get into looking at it. And also they want collateral. So you have to put up your building there, as you see, either your house or your building or your property. So you need collateral to cover the loan. If you're borrowing $400,000, $500,000, you need to have $400,000 in equity available to pledge for your loan in case you don't pay it back. And again, they don't want to touch a loan under $500,000. It costs them too much time and aggravation in underwriting. And so these 3 things are your options for a business loan. Again, only about 20% of the business owners out there can utilize these. The fourth way, though, a bank can help, and they can help more with, is what they call a real estate loan. And it's really not a business loan. It's the business owner takes a personal loan against their house. So they've got home equity. They own a house that's worth $300,000. They only owe $150,000. They've got $150,000 in equity, and maybe the bank will say, "Hey, we'll give you $100,000 against that $150,000 in equity. Let's take a second mortgage." So it's really a real estate mortgage. But these are options for that business owner. So that's what a bank is going to help them with. And in many cases, those are significantly, if a business owner only needs $7,000 and they can get approved for a line of credit, good for them. They should. But if they need $100,000 in this case, they can't get a line of credit, they can't get a big business loan, and they don't have equity in their home, and they don't have good enough credit to qualify, which now we're down to 80% of the businesses in America can't qualify for what you're looking at right there. 80% cannot qualify. So where do they go? Well, that's where we come in, alternative business capital providers. Alternative capital providers are easy for businesses to get approved. They look at your cash flow more than your credit scores.